Welcome to the Gray Report. I'm your host, Spencer Gray, joined by Matt Bosnagel, Director of Communications and Marketing here at Gray Capital. If you're a multifamily investor, any kind of real estate investor, whether you're passive, active, LP, GP, just curious, maybe you're working in the multifamily industry on site, this is the YouTube show and podcast that's designed really for you to keep you up to date and help you to make the most informed investment decisions related to, the multifamily industry. But we're covering everything from multifamily, real estate, the macro economy. Again, kind of keep you up to date. We've got a lot of great reports. Matt, you've got some really great ones. Some are on the newsletter last week that we didn't get into last week's show. Stuff from Marcus and Millichap. Bureau of Labor Statistics came out with CPI, PPI yesterday. I want to talk about that. But Yardy, NAR, Apartment List, Storage Cafe. Most importantly, we're going to be responding to some of your comments left on the Gray Capital YouTube channel. You can subscribe over on YouTube or get the podcast wherever you'd like to listen or watch. Let's get into it. All right, welcome back to the Gray Report. Matt, last week was a great show. We've put out a lot of interesting content, really trying to keep on top of the market with inflation, interest rates, all this growth that's going on.
Yeah.
It's a lot of moving targets here that you can hit or miss depending on what your approach is. Again, you put a lot of great reports together that get covered not only on this show, but even a more kind of a thorough layout of everything that's going on is on the newsletter or grayreport.com. Mm-hmm. You can sign up for the Gray Report newsletter hopping on over to graycapitalllc.com/newsletter. Again, that's going to deliver to your inbox every Thursday morning at 8:30. So if you want to stay in the know, it's the best multifamily newsletter in the industry. So sign up today after you've given us a like, subscribe, and a follow. But let's talk about the comments, Matt, because we're getting some really interesting comments on the Gray Report, on the Gray Capital YouTube channel. I thought we could address those. Let's look at those first. So MS, let's read the comment.
He says, what about affordability? Historically, multifamily has performed well during periods of high inflation. However, considering that recent property appreciation was due to low interest rates and excess liquidity from stimulus checks, now we are increasing interest rates, and it would appear stimulus checks are a thing of the past. So no more stimulus checks, and inflation from food could mean less money available for housing. The multifamily portfolios between Section 8 and luxury could be impacted. The consumer can only afford what they can afford, and the trend of people moving back in with family in incoming years due to inflation eating away at purchasing power, well, that could really come to fruition. This recent All In podcast discussed multiple layoffs in the pre-IPO space, as well as some companies going bankrupt. With lower valuation multiples, VC money doesn't want to write down already existing investments, and there's just less of a runway. Doesn't want to write down existing investments, which would need to incur in case they participate in a subsequent funding round for the same company. Cash and burn and cash runway is becoming the most important metric. There are a lot of growth companies with cash runways of only a few months. Interesting times ahead. At the first sign of material Fed capitulation, all bets are off, and I will find a home for my cash. There's a lot of food for thought there.
Well, yeah, there's a lot to that comment. A lot of really good points, though. Multiple points, to say the least. Matt, you made a reply on the YouTube channel. We're pretty active on the channel. What was your response?
Yeah, I love comments like this, actually.
Pretty long here.
And I really
summarize it.
Honestly, it was a great, a thoughtful reply. I would direct him to our interview with Noah Stone, and it does talk about multifamily performance in different periods of inflation and interest rate environments, talking really about how the tech-heavy NASDAQ suffers the most, which tech-heavy NASDAQ, you would associate that with the growth stocks and these, And
a lot of that's because of the discount rate that, those tech companies are valued upon. Inflation goes up, the future cash flows are less valuable, essentially. So they're getting just a less attractive multiple.
Yeah. And these are periods of what Noah Stone and Jonathan Rappa in their report called quasi-stagflation. It's periods of low growth and high inflation. And this way, and so in that scenario, which is one the commenter described, multifamily really does perform better than the stock market as a whole and as NASDAQ, definitely. Now, his discussion about food prices and budget decisions that may impact it. That's not a foregone conclusion, but it is worth noting, and we'll dig into the actual numbers here, that food prices were up 8.8%, and rental housing, multifamily housing, only up 4.4%. So that's half of that. Yep. And, 8.5% for all items, but still rental housing is low compared to CPI as a whole.
So I guess the question is, on one hand, you could say, okay, there might be some room for growth for housing, but I think what his comment is you can't squeeze any more blood out of a turnip. Like there's no more money to... The affordability is such a factor. You can't pay anymore for rent.
Well, and that's something that I put in some of our show notes when we were talking about when we talk about the CPI and specifically is housing is such a big chunk of people's budgets that a small little move in the price of housing has an outsized effects on people's budget. So, bread a little bit more expensive or like a sweater is maybe more expensive, but the change in the price of your rent, the change in the price of the house, which you can't get around it, that's going to really have a big impact. So that 4.4% does a lot of heavy lifting when it comes to people's budgets.
Yeah.
And then finally, my other response was basically, saying a lot of the rising valuations of multifamily property is due to continued investor attention.
Yeah.
Investors I think it still remains to be seen whether we're going to see a significant cooling off due to interest rates, because there could be a scenario in which investors looking at a recession continue to come into the multifamily market because it's a historical hedge against inflation.
Yeah,
and other economic volatility.
We're still seeing that. I mean, definitely we're seeing a little bit less of just the incredible speculation, because a lot of people, they're just not able to get the financing put in place because interest rates have moved and they can't clear that debt service coverage ratio hurdle. And so having to do lower leverage, which, does not allow them to, pay up as much because they got to put more money down. So there's that headwind. But to your point, there's so much capital, so much dry powder floating around, sloshing the systems even still. I mean, I think, at the end of 2021, there's about $250 billion of dry powder earmarked to multifamily investment that's already been allocated. It just needs to find a home. And they'll take lower leverage in order to get allocated because they do see the long-term growth potential. I think one other good question that the commenter asked was, okay, how about luxury properties and Section 8? Then he was really getting into kind of the slowdown in kind of the VC space in those technology companies, seeing those pre-IPO companies now with a lot of runway, less investment, and seeing some layoffs. And so it will be interesting that in maybe some of those kind of really strong, maybe really just tech-centric markets, maybe so like your San Francisco's, your Austin's, even Salt Lake City, Boston, where a lot of those startups are. Potentially, you could see some softening. Counterpoint to that, though, is we are at one of the tightest labor markets, in decades.
It continues to be, people are rightly so talking about recession and inflation, but it's like the job numbers haven't reflected that yet.
It's still tight, and I think they're good points though, and I think that's where you want to be careful on some of these really high flying, high growth markets, because you could see a little bit of a correction just because they are so high flying. Now, over the long period of time, I think they'll kind of continue their growth. But right now, if tech is going through a slump, you may see some softness. Now, I think there's still a lot of those jobs, and those are all high-paying jobs. And so maybe they're not getting, the $250,000, the $500,000, payday. Maybe it's, $150,000. Still can afford some really nice rent, assuming that they can actually find a job.
And the reports really this week really bear that assertion out, is that these ultra popular markets, they're not going to see the same amount of rent growth this year as they did last year, whereas the more stable markets are going to do a little bit better this year comparatively in terms of the proportion of last year's rent growth.
And one last point I would like to make on kind of the luxury Class A side, because I've had a couple people ask, this could be maybe bad for those high-end apartments. I really see it as the opposite, but it really relates more to the single-family home market in the housing affordability, because you've got a lot of people making a good salary, they've got a good income, they even have some cash, but they either can't find a home or that 5.5% to 6% interest rate to buy that home. They're like, maybe I just might take a break and rent for a couple of more years, which really grows the renter pool. And Yahoo News, there was actually an interview that maybe we can look at on the next week's report, that they've talked about that, of how they're predicting, and this is really research coming out of Zillow, they're predicting still positive single family home growth over the next several years. And their conclusion, that's going to drive a lot of people to stay renters and even grow the renter pool over time. So for on one side of the economy, maybe, or really housing market might be cooling down a little bit, but that still can be a driver for rentals as well. Yeah. And it's a little counterintuitive, because you're like, recession's bad, and recessions are bad. It's not good for anybody. It's more volatility, but that's why our apartments are in this great sweet spot, because you have people kind of moving down through the economic ladder. And there are rentals at multiple stages kind of along that ladder. So you lose your job and maybe you move out of that luxury apartment, or you have to move out of your single family home or your single family rental. You move into an apartment. Maybe you move from A to B class or B to C class.
And recession wouldn't be good for the apartment. But there are counter forces in the apartment market that could, kind of bolster rent growth, or maybe create a little bit more stability. Whereas a recession may directly impact. There's no counterbalancing force in other markets.
Yeah, when people have to start making sacrifices, and maybe they're not spending that that Starbucks coffee. Maybe they stop taking all the doing all this traveling, because traveling is, everyone's traveling around. People are spending a lot of money right now, on luxury goods. Especially trading, tradables, collectibles, all kinds of stuff that people don't need. You cut all that out, and you still need a place to live and prioritize housing. We saw that in the pandemic, and that's where 100% agree. Recessions aren't good for anything in real estate, but where apartments are, they're just a little bit insulated. We kind of have that stopgap, that stop loss, because it's just people need a place to live, and the kind of the middle and the higher, kind of quartiles of income earners, they're pretty well insulated anyway. In a big chunk of those, looking for a house, can't find it. Don't want to put the down payment, don't want to pay the interest rate. Some of these nice new apartments look like a pretty good option. Yeah,
I think that will be interesting to see, because, the Fed, it seems easier to think that the Fed may have temporary, they change things, rather than inflation. That's going to be a very persistent, kind of a long-term movement.
Yeah. All right, let's move on to one of the first reports. And again, if you want your comment talked about on the Gray Report, leave a good comment below this video or any of the Gray Capital videos or Gray Report videos. We will be sure to certainly reply to it, but if it's a good one, we'll feature it on the Gray Report. All right, next report up, Marcus and Millichap. What a hawkish Fed means for CRE investors. Matt, you want me to play this video, or just in the background, or you just want to hang out and talk about it?
We could just hang out and talk about it. I just wanted to note a couple things from this video.
I'll do a little bit of both.
That's fine. He says, the Fed's plan for quantitative easing is intended to reduce the possibility for a yield curve inversion, but kind of already happened.
Yeah.
So I don't understand what the logic is here. Maybe there's some kind of recursive kind of time travel sort of thing, but
yeah, that makes sense.
I would love to see what the logic is to prevent something that happened in the past. But maybe this does mean that it avoids the severity of a recession that's signaled by the yield curve inversion. However, the possibility, they say, of a recession is elevated, but not a foregone conclusion.
Yep.
And like we said, like we noted earlier, there's been great job growth, wage growth, really retail sales growth. They all seem to highlight inflation risk more than recession risk. Yeah. But really the pullout for this whole video is rate hikes. That's the discrete thing that we can point to. These rate hikes are something that you got to be ready for. They say that all this hawkish stuff from the Fed is to avoid recession, but I sure hope it doesn't tip over and cause one, because these are the real huge data points that we got to watch, rather than this. There's a potential for a recession. We have to be ready for it. But right now, the rates are rising, and so if you don't have a plan for that right now, then
and I think a lot of it's been priced in. Although it seems like the stock market is a little bit late to the game to kind of price in the full maybe 200 basis point move in the Fed funds rate. But you have to be pricing it into your underwriting and what your projections are going to look like, and that's going to be bringing down returns, which certainly could be softening the market on. But to your point, the big question is the Fed going to basically create a recession? And they said basically we're going to tighten until something breaks. Now, one concept that I've been kind of toying around, back here in my mind recently is it's really kind of a concept of almost like the fourth form of monetary policy. Really the Fed is supposed to only have kind of two major tools, moving the Fed funds rate and, kind of quantitative easing, kind of buying treasuries and securities. The third one people talk about, you hear Ray Dalio talk about this, is kind of more like fiscal policy, which that's Fed's monetary, not fiscal policy, but kind of encouraging, governments to spend money essentially to drive growth and, increase the velocity of money.
So like treasury stuff.
Well, they're spending money, infrastructure bill, just spend on whatever. Spend money. Now the fourth, which I think that is talked about kind of on the margins, is really all rooted in psychology. Because as we know, inflation and the markets are much more being driven by psychology and sentiment and people's collective opinions on things. Yeah. And we all know how powerful the Fed is, not necessarily what they do, but what they say. Oh, yeah. And may move markets just by, hinting at a few things. It'll move markets, significantly. Like Fed Governor, Brainerd last week was talking about they're going to move very hawkishly on tapering their balance sheet, unwinding the balance sheet, which is just massive right now. That moved the markets significantly. They've only moved the Fed funds rate. The interest rates that the Federal Reserve controls are still incredibly low. Yeah. So interest rates have risen on more of the market dependent and influenced longer maturity, bonds like the, kind of the 2-year all the way out to the 10-year and further. Those are much more dependent on market forces. The market has priced a lot of, increases in on that. That's why the 10-year is up at, 2.7% down from, 0.5% back in 2020. But there's still a lot of room to move on the lower end of the curve. And so I was asking myself, how much does the Fed actually have to do? And are they really, is part of it a bluff? Yeah. In a sense, they don't really want to move the low end of the financing rate. They don't want to move those short-term financing rates for a couple of reasons. One, it's what a lot of the major institutions and the banks, that's what they're borrowing at. And they want to keep those major institutions. They want to keep the liquidity flowing around. Banks, they borrow short and they lend long. So right now, if you're borrowing short at a low Fed funds rate that's right now, 0.3%, and you're lending out, we're at the 10-year Treasury at 2.7 plus whatever spread they're going to charge, that's a profitable proposition. Yeah. You bump that Fed funds rate up, all those big institutions, it becomes much less profitable, and a lot of loans floating loans are based on that shorter term rate. So active investments, not just real estate, all throughout the economy, you move that shorter term rate, that can really that can throw a wrench in the gears. Much more than the longer term rate, because the longer term rates, like the 10-year Treasury, that's what is used for really fixed rate financing, fixed rate mortgages, fixed, for a single family home or for an apartment building. So, that affects you when you're going to be locking in your rate today, but it doesn't affect someone that locked their rate in last year. So, you kind of going into that you're going to get a higher rate and it still works and you're not caught off guard. But if the lower rates get moved significantly and the talk is them being raised another 2% or 200 basis points, it's projected that at the next Open Market Committee meeting early in May, they're going to raise it another 50 basis points. So it'd be around, 0.8%. If that continues to move all the way up to 2%, that could be pretty destructive to liquidity and financing. And I don't think that the banks want that. I don't think the Fed wants that. And so the question is, they'll do it if they have to, if they're forced to, mostly because of political pressure and societal pressure of inflation is just too high. We need to get rid of this. But let's keep in mind, the Federal Reserve actually likes inflation because it actually destroys the debt. The federal government likes a little bit of inflation, because it erodes the value of their sovereign debt. Now, the only reason why they really have to raise it, in the wealthy, they're fine. They're fine. Well, inflation isn't going to get them. They're invested in assets. They're invested in real estate. The only reason why they need to raise it is because the 90% of people who are affected by inflation, they're not making $1 million a year. Their wages aren't keeping up. And they're saying food's going up in prices, gasoline's going up in prices. So it's a political problem to raise that interest rate. But the Fed really doesn't want to if they don't have to.
Yeah, I would say I would agree with that. I would also, I keep thinking about, interest rates were not always zero, going through the pandemic. So what was the economy like? In 2018, well, not 2018 because that's the taper tantrum, but
that's the last time they raised interest rates is when they really started rising in 2018 and started cooling the market, and that's when the yield curve inverted. That led to the yield curve inverting in 2019, which pandemic happened, but we still had a recession. Yeah,
so it's hard to see anything else. It's going to cool down from zero, but it's also.
I mean, it was always signaled zero is free money. It was like literally pumping free money into the system.
So I wonder, what's the sweet spot, anyways? And you can't expect it to be zero forever. But I do, we've talked about this before. There's a long-term trend, of lowering interest rates, or So I don't know where that's supposed to go.
They're raising it so they can lower it again, basically. Yeah. And the truth is, the global economy and governments and institutions and banks are addicted to cheap and free money. Like it's a literal physical addiction to cheap money, and that's where the Federal Reserve, again, they will if they're forced to because of political pressure. How much do they really want to? They're hoping that the market solves their problem for them. They hope that on the longer end rates, they get priced up. There's enough, volatility in the market, in the stock market, kind of corrects even further to where they say, well, we no longer can continue to raise rates because the markets are in turmoil and we just can't do it right now. That's what they want to have happen. They don't want to be the ones that lay down the hammer. Yeah, but they're the ones to do it. And they have a history of wrecking the economy because the position that we're in right now, and you could argue that it was necessary to create all that liquidity, but the position that we're in right now is in the inflation that we're seeing is because of monetary policy 1, 2, and 3. Yeah. 1, because they lowered interest rates basically to zero. 2, because they bought up treasuries, mortgage-backed securities, and even stocks and all kinds of assets. And 3, fiscal policy. Trillions of COVID money, infrastructure. Yeah. Now we got a war in Ukraine. Defense spending is not going down. So all of those three tools, even the third one, they're not really supposed to be involved in. They're all in full gear, and so now they're using this what I'm calling monetary policy 4, which is psychology, using basically psyops essentially to say what can we just say? Go out there in the public, say a few words, and can that wreck markets to a point where now it is not politically feasible or politically acceptable to raise rates and further hurt the economy, because they say it would be disruptive to the economy. And again, they're just looking at political pressure.
Their impulse initially was to lower rates during the recession. Not a whole lot of people were complaining that much.
Yeah, free money. They were handing out. Not only like our commenter said earlier, stimulus checks, but the stimulus checks that's like the small tip of the iceberg. And there's a meme that's floating around. It's like you traded in, you got your $1,400 stimulus check, but what in return what you got is 10% inflation and high gasoline prices, high housing prices, and hope you enjoyed that $1,400 because now you're paying double, triple on everything else. And this is exactly, this is how it works.
It's a little bit of an oversimplification.
It is, but it's kind of the truth. Also, these high prices. There's a lot of factors, but creating more money than has ever been created in the history of the Federal Reserve in a 2-year period. Yeah, if you don't think that has an effect, I don't think that we're looking at the whole problem in itself.
Yeah, it's a naughty. I'm glad I'm not on the Fed board, because you wanted to help people during the pandemic, and and they probably knew that this was going to happen,
Yeah.
What else could you do?
Yeah. Yeah. And that's what I was saying. I don't know what else you could have done. It's probably the right decision, but I think then we spent a lot of it on the fiscal side. I think we just spent a lot more money. They probably bought
That's
more. In retrospect, there's not the need to buy all these mortgage-backed securities to add liquidity. That market was fine.
Yeah.
So I think that they overreacted a little bit. They did overreact. They called the whole idea of transitory inflation completely wrong. It's not transitory. So they've missed it twice, and now they're saying they're going to be able to create this soft landing, which I think is possible. I think the market might fix it for it. I think that's certainly a possibility, but the Fed doesn't have the best track record of these types of soft landings. And that's why we just need to take preemptive measures to when we're looking at deals. Because again, the multifamily investment thesis has solid fundamentals. We got to position in the right way and build these business plans in a way that we can weather any kind of storm in the short term.
Yeah.
And I think it's going to be a short term. If we have a recession, I think it's going to be a relatively quick one. And then we're going to see positive growth on the other side. So if you have the ability to, again, weather the storm, batten down the hatches and get through, I don't even know if we're going to see much of a price decrease. I think we're going to see a decrease in price growth over the next couple of years. And a lot of that is going to be driven by the rent growth we're seeing. Because interest rates can go up, but if you've got rent growth that's outpacing, it becomes less important. It's not as important. It's still important, but it's not as important. If you don't get the growth, that's where you have a problem.
Yeah, I think I would agree for sure.
All right, so let's just take a look at some of the latest inflation data came out. This is last month's, looks like. But we had the most recent report that came. Oh no, this is the right one. This is for March.
Yeah,
I'm sorry, Matt. You got the right. You were on top of it. This came out yesterday, April 12th. Looking at consumer price indexing, and that's a basket of goods. How expensive is it compared to last year? We're up 8.5% year over year. Some of the big items were gasoline, up 18% just in March. Other energy components also increased. Food index rose 1%. Food at home increased 1.5%. Now, the one takeaway, I guess the silver lining that some folks are referring to is that core inflation, which is basically CPI, but you're going to take out food and energy because they say it's less volatile. How you take those out and actually get a good picture of inflation, I don't know, but I sort of understand the reason. That was a much more tepid at 6.5%, which isn't nearly as high. I think it came in a little bit under what people were expecting because I think just the high gas prices. But really got to look at that top line, just regular CPI. And again, we're looking at the largest 1 month percent change for quite some time. I think we have to go back to the late 80s. So I think 40 year. We're still setting these record high levels of inflation. Fascinating.
Yeah. When I got this report, I immediately skimmed to the section on housing. I'd been kicking myself because I was unable to track down a piece of analysis from a few months ago that found that rental housing is relatively undervalued. And I mentioned this before, that rental housing is up 4.4% year over year, and the total increase for all items is 8.5%, almost double that. Additionally, the 4.4 increase in rental housing was slightly lower than the rise in shelter costs of 5%. So for rental housing, I think that the 4.4% number is actually low relative to what we've seen reported, because the effects of the massive 2021 rent increases are still really trickling through the apartment market. At the same time, the cost of housing is often the largest item in the household budget, like I said, like we talked about earlier. So that 4.4% is a lot more painful than the 23.4% increase in rental cars, the 13.6% in stationary, or even the 35.3% increase in used cars. That last one is actually getting some attention. So
still hard to get a car these days.
I just heard of someone who bought a car 5 years ago, made money selling it.
Yeah, I believe it.
And what's interesting is and my other friend there was a used car and a new car. The used car was worth more than the new car. It's because now it's almost like people are seeing they're not out just because it's a year older.
Yeah, that's interesting.
And I wonder if how they say the price decreases right after you drive it off the lot. That may not be so true anymore.
Yeah, and again, it's all fascinating because they're supposed to be incredibly depreciating assets. I mean, I've got a truck that has gone up significantly in value.
Yeah.
It was probably worth about $12,000 a couple of years ago, and I could probably sell for $22,000.
Yeah, it's ridiculous.
It's a Tacoma, so they're in like high demand.
Mm-hmm.
But I'm like, what am I going to do? And I need my lease on my Tesla is expiring here in the next couple of months. I've been looking for another option. They're giving another one. It's going to be 2023.
Yeah.
I put a deposit down for a Rivian. They're like, we'll let you know at some point in the next couple of years.
Yeah.
What's the point?
It's scarce and valuable when it comes to cars, and it does seem a little bit ridiculous. But then again, these are things that people need.
Yeah.
And especially when it comes to used cars, people maybe are realizing, oh wait, just because it's used doesn't mean it stops being a car.
Yeah.
And so, I thought that was a particularly interesting thing, just on how it almost boils everything down. It's not about the shiny or new thing. It's about like these trucks that can do
utility.
the work.
Yeah.
The utility. And that's, and that kind of comes back to, housing prices in general. These are things that people need. And I still think that we haven't seen the full impact of the 2021 price increases, just because, and we've talked about this before, the market rents, the asking rents have been elevated hugely, but the people that are already living in there, their rent increases are going to come over time. It's going to be a much slower progression.
Well, and that's the big difference between you look at kind of housing in general and CPI compared to like market growth, because you have they're taking into account everyone who already has a mortgage, who's already bought a house, who already has a lease, and not just looking at what, if you're going out to buy a house today or rent an apartment today, what that growth is.
Yeah.
And so when you factor all that in, it's obviously a lower number, and that's where the new and used car sales are really incredible.
Yeah.
So switching from the consumer price index over to the producer price index, these are like inputs. This is like what goes into making all the stuff. And people will say that the CPI is a lagging indicator because it's like what people have already paid. PPI is maybe a little bit of a forward-looking indicator because this is like the materials that go into the stuff that's going to be made that people are eventually going to buy. And it is up quite a bit as well, increased 1.4% just in March. That's a huge just monthly gain itself. So we're going to continue. I mean, look at this.
So just compared to the CPI, the year-over-year increase for the PPI was 11.2%, and the year-over-year increase for the CPI was 8.5%. So if it is a lagging indicator, then we may see CPI move even further.
Yeah, even further, which again goes against a lot. Again, we've talked about this a lot. There's a lot of models. There's a lot of projections who are basically saying that demand and growth is going to just tailor off near the end of the year. It's just going to disappear. And the only good piece of evidence for that is demand destruction because of high prices. People are just going to be squeezed out. They can't pay anymore. But when we're looking at all the data of just where prices are continuing to go, there's not a lot of evidence that it's just going to just fall off immediately. Especially war in Ukraine, other supply chain bottlenecks. And we've complained also, looking at some rent growth projections and forecasts. I think people are trying to play it relatively safe.
Yeah.
And they're basically simply just trying to revert to the mean as quickly as possible. Because I think that they are afraid of saying that there's going to be 10% rent growth this year or even more, when we already saw year over year in March 15% rent growth. So we're seeing stronger rent growth in not even the peak leasing season. We're just getting into leasing season. We're seeing CPI. We see how much more housing rooms has to go, and we are seeing wage growth. And so that kind of adds to that wage price spiral. I don't see how rents aren't going to have another, maybe not record year, but it's going to be pretty strong. And that's more than I thought. But a lot of these projections, they're really kind of pulling the projections out of thin air and trying to just kind of temper everyone's expectations, which I think is probably healthy, but I just don't think it's necessarily the reality that we're going to see.
Yeah, I wonder... And I'm sure it wouldn't be too hard for me to find out is what's the lag time? We're talking about leading indicators. What's the lag time between a Fed rate hike and the impact it has on the economy. And when are we going to start seeing the demand that they promise is going to go away actually go away?
Yeah.
Because it's a promise that the Fed has tried to kind of psychologically program us that this might happen. But
well, at least it's moving like like the stock market. Those markets are moving. Those react right away. But how it affects the actual economy, I think that's a bigger question. I think it is much more delayed. It's not until it kind of trickles down through kind of markets, and all of a sudden people have to be, the job market cools down. People aren't getting raises. The wages aren't growing. People even getting laid off. Once that happens, then it's like, oh, now we're in a recession. By that time, the stock market is now maybe even growing a little bit because they're pricing in that recession and interest rates falling. So you have to look at kind of these different, where the actual economy is, reality, and that's where apartments and real estate usually lie. I mean, you still have buyers and renters. They're not looking at CPI. They're not looking at inflation. They understand that things are a little bit more expensive, but they're not necessarily reading the Fed the open market committee minutes to making their everyday decisions because they're like, well, CPI is up a little bit. I need to temper my purchases. They're looking at their pocketbook, their bank account, which people still have record savings levels, and they're making decisions for what they're making on a day-to-day basis. So it is delayed. Pent-up
demand was such not an excuse, but it was such a justification for a lot of the inflation that we've seen, a lot of the continued demand. Yeah. I wonder if there's still some pent-up demand ready.
I think there absolutely is. And the people are taking advantage of it. I mean, we're seeing it in hospitality right now. I mean, I think I was looking at some hotel prices, looking at going on some trips, just later in the year, and hotel prices are like, they are double than they were a year ago. We had, Alex and I, we had some trips scheduled, first in 2020, we kept canceling it because there were the lockdowns and everything. The prices of those rooms have doubled and sometimes more than doubled from when we were first looking at them. Yeah. I mean, where it's like you get like you go to a really nice hotel, maybe you're paying $500 a night for a room, plus or minus. Now those are all like $1,000 more. On peak times, they're like $2,000. Like we were looking at a place down in Cabo, and it's like $4,000 a night. I'm like, that's not.
Yeah,
who's paying that? A lot of people are paying it.
It's all like you could see two different possibilities right there, because short of this, this kind of frenzied and anxious environment, whether it's a recession or Fed tightening, if you take that out of, if that wasn't in the picture, man, I would be looking at places like Orlando and Tampa and Naples. All of these Sunbelt cities would be deservedly good places for investment because there's going to be tourists coming in there. That's going to require a larger workforce, and that's really could drive so much of that market, which is still going to happen. Yeah. But there's a lot more uncertainty now that
I think there's uncertainty. I think they are going to still see the growth because of that. Yeah. And people will continue to travel. Even it has to get deep into the recession for people to finally say, "Oh, I'm not traveling." And people, once you're out of the recession, people are still nervous and they're shell shocked. I mean, remember kind of 2009, I know, 2010, 2012. People are still like, no, in this economy, I'm like, well, there's actually things are looking relatively decent right now. So in context, Matt, you wanted to bring this up. And I think this is a good point. Looking at, the United States is not alone. I mean, this is inflation rate by country in 2022. Pretty much everyone is in a pretty similar boat.
Yeah, it is interesting. Just looking at and I don't know a perfect way of translating this, but it does seem like much of Europe is experiencing the same amount of inflation in Australia as the United States. Now you could use this to say, oh, it's not the Fed's fault. It's not the current administration's fault.
It's central banks around the world and other central banks like the ECB. They're even more dovish than the Fed is. The Fed is relatively more hawkish, which is why we've had higher. They've all had negative interest rates in the past, and we still had positive interest rates. We hadn't gone negative on actual nominal rates, and so they're seeing even more inflation. And in Europe, they've got the war in Ukraine is affecting them much more than it is in the United States, even though we're still feeling some of the impacts.
Yeah, what it does instead, I don't care about reasons or whatever. It illustrates the size of the problem and the difficulty that the Fed and everyday Americans are going to have to kind of get over this problem. It's not going to be an easy switch, and it may have, it may have some staying power despite what the Fed tries to do in the short term.
Yep, I agree. All right, so let's move on to the Yardy Matrix National Multifamily Report for March 22. We always look forward to these reports. Yardy does a great job. Yardy Matrix, if you're not familiar, this isn't an ad or sponsored by, although we would accept probably a sponsorship. They're a big property management software firm, but even more important than that, they collect all the data from all the properties are managed with their software. So they've got a lot of great data. They're almost more of a data analytics firm than anything, although they obviously property management is their bread and butter. Property management software. So Matt, what are some of the takeaways from this latest Yardy Matrix report? Right.
Yeah,
just read that. I'm just going to read the headline. Record gains despite emerging headwinds. Take it away.
And that's it. And that's the story for this past month, really. It's like you see all these good news, and particularly in the multifamily market. Rents grew a record amount in the first quarter, 2.1%. There has not been a first quarter in measurable history that has grown as much as the first quarter of 2022. But at the same time, they also signaled some concerns over energy prices and, oddly enough, rising rents as fuel for inflation. That being said, demand is still high, and it's been led by workers whose rising wages provide the wherewithal to form independent households apart from parents and roommates. I'll have to keep an eye on how this narrative plays out, because for the past 14 years or so, the story that was repeated was one where young people were staying home with their parents for longer periods of time. So with that being said, I would keep an eye on household formation to see what might change in a potential recession. For 2022 as a whole, Yardy Matrix predicts about half of last year's demand, which is still, they say, still pretty healthy demand. 250,000 absorption instead of 500,000 absorption, and household formation of 1 million in 2022 instead of the 2 million of 2021. These aren't bad numbers, all told, but definitely it is. It's not the kind of crazy numbers that we saw in 2021.
Yeah. At least those are the projections, at least.
Yeah. And the report also notes the same point that I had kind of, and that we talked about too, is that the CPI may not fully account for the growth in the cost of housing, since record high rising rents get filtered into the index over several months, if not really years. Rent growth by the year end is expected to be double or more than historical averages, but it looks like, according to their projections, the huge markets for rent growth, the places like Orlando and Miami, those are going to see a sharper drop-off in rent growth for 2022. As Yardy Matrix says, signs point to demand in the Sun Belt and West cooling off slightly. Occupancy rates in several markets have decreased over the last year as demand hasn't kept up with deliveries.
Interesting. We've been talking about that a little bit.
Yeah.
Again, there's super strong growth in a lot of those markets in the Sun Belt, but like a lot of construction.
Yeah.
And it's just, it's a lot of good, standard exit, deviation from the mean, and huge growth and volatility. But again, there's, can be some corrections and that reversion a little bit, and like, hey, maybe we've gone over our skis a little bit.
If you look at rent growth alone and you're going in there and as an investor and trying to buy something, you have to also think that developers are thinking that same thing. And so, yeah.
They are, and other investors, and so a lot of that is already priced in, but so many of the valuations are no longer based on last year's trailing 12 months or actuals. Not even based on the trailing 3 month anymore, which is a little more aggressive. It's like, what are the next 2 years of earnings, of income, net operating income, and that's fuel for speculation, because again, if you had like super low interest rates baked in, you had super high rent growth, maybe both of those things will happen. Maybe one does, maybe one doesn't.
Yeah.
Maybe they both don't. So, all right, let's move on to the next report from the National Association of Realtors, NAR Overview, Sustained Commercial Market Recovery with Risks Ahead. So variation on the same theme.
Yeah. There's some headwinds, kind of across the board, but again, they aren't really signaling it as potential recession, but they are, and maybe next month they'll talk about this, but this is inflation, and it's a concern really for CRE in general. They record rising valuations and investor acquisitions across the board, as well as rising demand for retail, office, and industrial. But inflation could impact industrial with potentially less demand for warehouse space, and retail could suffer as shoppers buy less from malls and shopping centers and kind of prefer maybe the more kind of essential going to the grocery store as opposed to kind of going to, going to the strip mall.
Yeah, I can see that.
Yeah.
I mean, well, I guess you have to go to the grocery store. Maybe you don't have
That's
to.
right, yeah.
Maybe you don't need to get your nails done, but, my Alex may disagree.
Again, all of the sectors they look at here showed growth, and even office with work from home down to 13%, it's doing better, and a whole lot better, really, for apartments. They led the pack as NAR measures it for year-over-year rent increases. Apartments were up 11.1% compared to 0.7% for office, 10.6% for industrial, and 3.9% for retail. All of those are pretty strong, aside from office, which we know the story for that. All of those are very healthy numbers.
Yeah.
And I think that one interesting prediction is that they expect rising interest rates to drive would-be homeowners, like you said, into the rental market, as they will not be able to afford a mortgage with higher interest rates.
Yeah, I'm holding off. Like, I like the idea of people were ready to buy a house and they were stretching at low interest rates, right? Because the prices were up. They're like, but the more, it's free money because it's like the interest rate's so low. But now it's like, okay, the money's not free anymore. I could barely afford it at a 2.7% interest rate. Certainly can't afford it. I'm paying a 5.5%, 6% interest rate. One thing I wanted to look at real quick is just job growth, because I'm focused on where the jobs are going, where we're seeing the growth. Because I've been told by some really smart people, population growth is important, but population usually job growth leads population growth. So just as some metros that we're seeing, it's looking at the highest net job gains in the thousands and the highest net job losses. So maybe places you want to be looking forward to investing in, and maybe some of the places you might want to avoid. No surprise, Tampa, Phoenix, Nashville make the top 3, Provo, Utah after that, Jacksonville, Florida, Salt Lake City, Raleigh, Boise, Idaho, handful of other.
It's interesting that, and one, I'm not sure if we'll be able to get to this report, but one of the reports said that the 2 cities that are, and it's kind of self-explanatory, they're the biggest cities, but the two cities that dominate the migrations out of state are New York and Chicago, and they're up at the top here for the highest job losses.
Yeah, New York, Los Angeles, Chicago, San Francisco are all the top for the most amount of job losses. One city that we always like to mention, because it is where the Gray Capital HQ is located, and we have a major concentration in the market, that Carmel, Anderson, Indiana. That's right kind of in the middle of the pack for kind of the highest net job gains. And, they're just looking at this on a nominal basis of, the number. Indianapolis is a much, relatively smaller market compared to pretty much, any of those other markets, maybe outside of Sarasota, Florida, which is kind of a Tampa, it's, near Tampa, but maybe not. Provo is relatively small too. But, Charlotte, Tampa, Phoenix, Nashville, those are much larger markets. Indianapolis, I think, is punching above its weight class just a little bit. And that Fayetteville, Springdale, Rogers, Arkansas, Missouri, that's a really attractive market as well. We got Elkhart and Goshen, Indiana. We've got some properties up near there. But really, Indy is beating out the job growth, and even a lot of the Sunbelt markets that you hear talked about quite a bit, like the Durham, Chapel Hill, Knoxville, Tennessee, Cape Coral, Fort Myers, Florida. A lot of markets that are very popular with multifamily investors. And I would have to say maybe not the worst market, but the most lagging market for multifamily investment has been, since the pandemic, has been Minneapolis. They just have been absolutely struggling. They've had the least amount of rent growth out of any major market. And I feel, it's for a lot of different reasons, but Minneapolis has really taken it on the chin recently. NAR, National Association of Realtors, does a really good job putting these reports together. You can find this report, by subscribing to the Gray Capital newsletter over at graycapitalllc.com, or just check grayreport.com every single day for the most recent research reports, all that original content from the Gray Capital team. Okay, so apartment lists got a new kind of interactive little tool looking at apartment vacancy rates over time. Now, I did find this interesting because I think we just got another report, and I'm spacing on who released it, but that we saw occupancy increase a little bit. But the apartment list, which they sometimes have a little bit different numbers, shows occupancy decreasing and vacancy just peeking its head up just a little bit, kind of through the end of 21 through 2022. Matt, what do you think about this? And it's really breaking down kind of core, national, and suburban. Seems pretty correlated to me.
Yeah, I think it is interesting just the way that different markets differ here. It's not always the case that the suburbs are seeing greater demand than the downtown. It's definitely generally true, but it's not the case everywhere. Each of these markets has a different story. Some of these markets have a significantly more demand in the suburbs, but other ones they're very even. So, for example, if you look at Indianapolis, there is a sharp divergence. Suburbs are about a half a percentage point, maybe a full percentage point different.
Just absolute plummet. I mean, I remember touring apartments and talking to property managers at suburban properties, and just the conversation of people are just moving out of downtown, moving out to the suburbs.
Yeah,
and we really, this is flatlined. A little bit of pickup, kind of in the core and the metro, still pretty flat compared to national. But man, suburban, that occupancy is it's actually even lower.
Yeah.
Right now.
And then if you look at another one, let's say Cleveland. Cleveland is much different. It has
everyone's moving out of the core. They're getting out.
Yeah, but you don't see
that's been going on for a while, looks like.
They're all moving out of the core, but then they're not necessarily moving into the suburbs. The suburbs don't have that sharp.
Well, it was already low. It's gone low. Yeah. It's gone lower, but it was already low.
Yeah.
Cleveland probably had some of the core, which is core is like the downtown CBD, and the metros I think is kind of overall.
Okay.
So overall it's relatively stable, but yeah, everyone's been moving out to the suburbs in Cleveland for a while. It seems like. Any others you'd like to take a look at?
No. I want you to pick one now. Because this is the thing is like you're going to see a different story for every city, and there's
look how tight that is.
So that is really interesting. For a while, the core in Salt Lake City was below the had higher demand than the suburbs, but now they are neck and neck. They are virtually the same.
Well, this is vacancy, so this would actually be lower.
Yeah, higher. Well,
higher vacancy.
At one point in late 2021, there was higher demand in the core than the
even
suburbs.
Recently, yeah. Which I think Salt Lake City has some unique drivers, and that they've got a nice little core. Where at Cleveland, people aren't wanting to hang out in downtown Cleveland, but they are wanting to hang out in downtown Salt Lake City. Or at least apparently. Let's look at Minneapolis, because Minneapolis is one of those that has just really, again, just had a lot of drag on it. Minneapolis, St. Paul, Bloomington. So again, this is also related to. This is like specific events from Minneapolis. We had the George Floyd protests, everything that was related to that, and that just sent people moving out of Minneapolis in droves. They're like, I have had it up. I'm not living downtown. I don't want to get my place burned down. Just occupancy. I mean, just
you see core making that huge dip in demand, a huge rise in vacancy right around the start of 2021, whereas the suburbs have remained relatively flat.
Yeah, relatively unaffected. Just curious, Kansas City, kind of similar to Indy, which makes sense. They kind of track each other, but relatively more correlated. A little less all over the place. So this is really interesting. And again, you can check this out. You can go to Apartment List, or you can find it just directly on grayreport.com. Sign up for the Gray Capital newsletter, graycapitalllc.com/newsletter to stay in the know. All right, Matt, the last report we have, stick around, because this might be the best one. Migration and moves. Storage Cafe, U.S. renters migrate towards feeder cities with Dallas suburbs among the biggest.
So
renter magnets.
This report was released relatively recently, but it covers the moves made by renters in 2021. Noting along the way that there was a 10% increase in renter applications in 2021 compared to the year before. So that's even kind of independent of their migration. The map of the top places shows that people moved to a lot of the Sunbelt markets, and you can kind of see that in the map they give there. Places like Dallas, Fort Worth, and Orlando. But they only have a couple of places in the Midwest on this list. Overland Park, which is in the Kansas City area, and Lansing, Michigan, which is one that we're particularly interested in. So
yeah, and we've got a beautiful property under contract now up in Lansing, Michigan. This wasn't even a planned thing to talk about it, but it was one of the first assets in the Gray Fund. We're in suburban Lansing, Michigan, Okemos submarket. It's beautiful, 1989, 1991 construction. 406 units, solid B class, in a just incredible suburban market, strong job growth, population growth, kicking on all cylinders. So yeah, that's nice to see. Lansing is up there. We always like to. We were looking at this data prior. This came out 2 days ago, so it's nice to see one of the markets we are making an investment on this list for net migration. Good to see.
Yeah, and like I said earlier, they said that the top 2 cities for outbound migration are New York and Chicago.
Makes sense. Wow, man, look at all these just Texas top 10 cities for net migration. A lot. That's quite a few. And Orlando, which you were talking about a little bit earlier, Matt, is on the list as well. Which again, I think that makes sense. And New York City, Los Angeles, San Francisco, sucking wind, as they have for a while. Although. Yeah, it'll be interesting because a lot of people are predicting once a lot of the lockdowns ended, so maybe those New York markets would come back, but still not the same. I think people are still kind of working remotely.
Yeah, it is that has been one of the more surprising and not necessarily unanticipated, but I was a little bit surprised at how many of these pandemic-related habits or migration patterns or really like kind of the work from home trend, even though it's down to 13%, it's still persisting, and there are these changes may not be temporary. There are certain things that are here to stay.
I agree. Well, Matt, an excellent report. If you want to get these reports sent to you every single week, hop on over to graycapitalllc.com/newsletter. But don't do that before you give this video a like. You subscribe to the Gray Capital YouTube channel. You check it out. It's available on a podcast also. Spotify, your Apple Podcast, your variety of podcast. Wherever you get your podcast from. So make sure you check it out. If you are interested in investing in multifamily apartments, you're already a multifamily investor, and you are a accredited investor, highly recommend popping over to gray.fund. You can get this full presentation, download the PDF, going over all about the Gray Fund. I think it's a very unique structure, great opportunities. We've got some great projects under contract. You can go check out the full presentation, charts and graphs, all kinds of stuff, bios. Learn a little bit more about what Gray Capital does and the Gray Fund. As you can tell, we are very focused on data. We've got I think we've got a good, sense of intuition as well, but really on top of where the markets are moving, trying to make informed decisions, not, using our gut, but not just relying on our gut. And that's what's all baked into the Gray Fund. So hop on over to gray.fund. Just type it right into your browser. Gray.fund. That's Gray with an AY, GRAY. I need to remember to tell people that. Learn more about it. Schedule a meeting with myself, any one of the members of the Gray Capital team. We love to sit down, have a conversation with you, go over what your goals are for investing in real estate, figuring out if this is the right strategy for you. If it is, love to partner with you and make some great real estate investments here in 2022. And again, we're taking all this inflation, recession worry, we're taking all that into account, hedging the risk, hedging interest rate risk, really removing a lot of those risky variables from the equation entirely, looking at a little bit long term, not looking over the next year, next 3 years, what's going to happen 5, 7, 10 years out. If that makes sense for you, looking for a more conservative approach, hop on over to gray.fund and get started. Matt, great show.
Thank you.
Thanks again. This is good stuff. Looking forward to being on with you again next week. And we'll catch you there. Same bat time, same bat place.
All right.
Take it easy.